Okay, in chapter 24, we are looking at 4 different ways in which to evaluate whether or not we should pursue certain investments. So we have the number of revenue and expenses, cash inflows and outflows projected of what we think we're going to bring in related to this particular investment. Should we actually do this? Does it make sense for our company? There are 4 different ways to do it. The first one is a cash payback period. So this is a real simple calculation. I've just given you a quick example here. We have purchase an asset that costs $16,000, but using that asset, we're going to have an additional $4,100 of cash inflow every period going forward. So we want to say, how long does it take to recover that $16,000? It's a real simple calculation. We'll just do 16,000 divided by 4,100, and that equals 3.9 years. Okay, now if these were uneven, there's an example on Exhibit 24.3 where you have uneven cash flows. We assumed here that this was 4,100 year 1, year 2, year 3, year 4, on and on. But it might be a situation where we have like 5,000 and then 3,000 and then 6,000, etc. So we would just look at the cumulative of this rather than dividing. So we'd just say, how long does it take to recover the 16,000? So here, we're at 5 and then 8 and then 14. We're still not at the end of year 3 recovered. If in the end of year 4 we had another 3,000 there, then we would recover our investment in the 4th year if they were uneven cash flow. So what you would do with this information is you say, well, what is our company standard? If we have a policy that says we're not going to do any investment unless we can recover our cash from that investment in the first 3 years, well, then we would not do that investment that returned it at 3.9. You would just compare whatever you got to whatever your requirement was based on whatever your internal policies was. Okay, accounting rate of return, that's the second one. What we're doing here is we're calculating the estimated amount of income from the investment divided by the average investment. So how much are we bringing in, dividing it by the average of what the investment is. So in this case, we bought a machine for $100,000. We used it for 2 years, getting $20,000 in income. We're including depreciation there. So we're just looking at $20,000 net income. What we do, we would take what is the actual investment return. We would divide that by the average. Remember, whenever we said if you have a ratio that includes one item from the income statement and one item from the balance sheet, on the balance sheet part you're going to use an average. So here is the return. This is an income statement item. We look at the average asset value on the book. So we have 100,000. We said it depreciates over 2 years. So at the end of the period, it's going to have a 0 balance. So and then we divide that by 2. So this is essentially 50,000. 20,000 divided by 50,000 is 40%. Okay, so that's our rate of return on that one. And just like we would a minute ago, we compare that 40% to what we require from whatever our company standards are. You would think 40% is a pretty good return, but we might compare that to another opportunity to invest that would be 50%. So we might go with a higher accounting rate of return of the various investments that we have. Now, one of the key things you need to know that I've noted here for you under cash payback period and accounting rate of return, both of these ignore the present value of money. So what's the present value of money? That's the assumption that says $1 today is worth more than $1 in the future. Now, if we went back to 2008 before the stock market went kaput, that might not be true. You might have more worth of 2008 if you just stuck your dollar under a mattress rather than investing it the way that the stock market went. But in general, $1 today is worth more than $1 in the future because we can invest that and earn a return. Now, I noted for you here the parable of talents. Hopefully you have read that before or heard about that before. It's in Matthew 25 and Luke 19, talking about taking what God entrusts us and being fruitful with what we're entrusted to bring more fruit and more opportunity to pass. So that's an example of the talent where somebody is given 5 coins, somebody's given 3, somebody's given 1, and the one who's given 5 goes out and he earns 5 more for a total of 10. The one who's given 3 goes out and earns 3 more for a total of 6. And the one who's given 1 is scared to do anything with it, and so they just bury it under a rock or hide it under some part of their house, and they just come back into the owner and they just say, I still have this 1. And the owner scolds that person and says, you were entrusted with this to earn a return, but you didn't do anything with it. So just a little biblical tie in there. That's kind of the concept of present value, is we're using this money to earn money going forward, and so we need to build in that present value concept into how we evaluate our investments. That's what we're doing in part 3 and 4.